Good morning, everyone, and welcome to the 20th episode of the Capital League Insight series of webinars. The topic for today's discussion is Global Disequilibrium. Now, we are all familiar with the ancient Chinese curse, which says, "May you live in interesting times." And for much of our lives, this seems to have been a blessing. However, while navigating the pandemic for the last 2 years, followed by the crisis in the global economy, resulting from the Russia-Ukraine situation, it is indeed sounding like a bane. So ever since the 18th century economist and philosopher Adam Smith propagated the modern capitalist theory encompassing free trade, the world has embraced globalization, never looking back. So we have been in a state of dynamic equilibrium, so to say, with each country benefiting from the lowest cost advantage of a product or service offered by another nation. Equilibrium, as we all know, being a state where opposing forces and influences keep each other in check and in balance. However, the ripples emanating from the pandemic and geopolitical developments have affected countries, economies, commodities, markets, and communities across the globe. And the first, second, and third order effects of these events are wreaking havoc on supply chains of food grains to semiconductors. So the crisis has resulted in inflation levels last seen 40 years ago in the developed world. For the last 3 decades, China and India exported deflation to the West in manufacturing and services respectively. But as we all know, the story has changed. The biggest fallout of Trump's anti-China policy, as well as the events of last 2 years, has been the breach of trust, where no country wishes to be at the mercy of another. Each country either wants to be self-sufficient or is seeking alternate sources of supply. Simultaneously, the central bankers around the world are trying to tame this 40-year-old high inflation by increasing interest rates and sucking out easy liquidity at the cost of economies tipping into recession. Reversal of liquidity flows has created a risk of environment that has negatively impacted emerging markets, including India. Higher interest rates have also dented valuation of high quality, expensive stocks, especially technology stocks in the US. And amidst all this, China, with its stringent zero COVID policy, is going through one of its most unpredictable phases when it is imposing fresh regulations on its tech sector and trying to rein in the runaway real estate sector. So how do these events impact Indian investors? And is there an opportunity for long-term investors in the midst of this global disequilibrium? So we shall today take stock of current global economy, the actions taken by foreign governments and their political ramifications, the dilemma faced by the central bankers, as well as the more fundamental currents and changes underway that may change the face of global economic order. And to understand this wide spectrum of developments and changes happening across the world, we have with us Supreet Pan, Head Southeast Asia and Institutional Sales for JP Morgan Asset Management, joining us from Singapore. He manages the investment needs of central banks, sovereign wealth funds, pension funds, and asset managers in the region across equities, fixed income, and alternate strategies. Supreet has a rich experience both in India as well as international markets. And with his background and experience, he is best suited to unravel the changing world scenario and simplify it for us. Thanks a lot, Supreet, for joining us today. Welcome.
Thank you for having me, Rajul. It's my pleasure.
It's our pleasure too. We are grateful to you for your time. So before we start the discussion, I would like to mention that we shall have a 15-minute question and answer session towards the end. So request you all to please type your questions in the Q&A section at the bottom of your screens and address them to the panelists. So Supreet, before we deep dive into talking about the specifics of various things, can you give us some color on the current international situation with regard to global economies and markets? And starting off with inflation, interest rates, and recession, which is, of course, top of mind for everyone, especially after the Fed Chairman Jerome Powell's comments yesterday Do you share his views on the tenacity of inflation and a need to keep interest rates higher for longer?
Thank you once again, Rajul, for having me, and good afternoon, everybody. Just before I kick off, can I make sure that my screen is visible?
Yes, it is clearly visible. Thank you.
Okay, great. Once again, to all of you who've joined us on a Saturday morning, I really appreciate you making time. I do feel the list of activities that you could be doing on a Saturday morning is infinitely long. And in that context, I'm grateful for you spending 1 hour of your time with us. And as Rajul mentioned, I do welcome your questions after the discussion that Rajul and I have.
Sure.
I think Rajul's teed me up quite nicely with her opening comments, which are very eloquent because she gave us a nice background of the way the global economy is poised. And it also compels me to state that the world that we live in, or the economic order that we live in today, is vastly different from the economic order that we've lived in for the past 12 years, since the global financial crisis in 2008, 2009. What am I referring to? Since the global financial crisis, the central banks had pumped in extra liquidity into the global financial systems to support the economies. There was practically no inflation in the world. In fact, in the developed part of the world, Japan, Europe, they were battling deflation. As a result, we lived in a time that the interest rates in those economies was either negative, as was the case in Japan and Europe, and in case of US, negligible, close to zero. And we also lived in a time that the commodity prices were range bound. Fast forward to today, particularly the world that we've been living in over the past 6 to 9 months, you see a mirror image of that. Now, the central banks are sucking that excess liquidity out of the financial system, which is called quantitative tightening. Inflation, as Rajul alluded to, and you must be reading about in the developed part of the world, is a significant problem. And as a result, we are no longer in a negligible or negative interest rate environment. And to top it all, commodity prices are no longer benign, particularly when it comes to energy prices, which seem to be quite high relative to what we've experienced in the past. So before I kick off, let me just first of all acknowledge that the central message through our discussion today is, as an investor, it pays to be prepared for a range of outcomes. Because we live in a different world than we've lived in the past 10, 12 years, this is not the time to be a cowboy, to assign 100% probability to 1 or 2 events that may take place. So please remember that's going to be the central thesis, which is prepare for a range of outcomes and therefore diversification in your portfolio. So I very often like to start this discussion by speaking about the most important economy in the world. You must have heard of this cliched analogy now, which is if the US sneezes, the rest of the world catches a cold.
Absolutely.
Therefore, let me spend a little bit of time on this because US does contribute 25% of global GDP every single year. It's a $22, $23 trillion economy. And therefore, we must take a look at what that economy is doing because that's going to determine the direction that the global economy also takes. What we've got for you here is a very colorful chart. I apologize that it's a little busy one and some of the charts are going to be busy, but I'm going to try and simplify them for you. It's a heat map. If you see the blue dot, the purple dot or the diamond in the green zone of a financial metric that we are tracking, it means there is less indication of a recession because of that indicator. But if you see that purple dot towards the red zone, it means it's flagging red, which means that typically in the past, when that indicator is in that range, it's followed by a recession. Instead of going into each one of them in detail, just notice that there are 2 such metrics, which is manufacturing and consumer confidence, which are beginning to show a red flag. Unemployment is historically low in the US, which is why the bar on the extreme right-hand side is extremely green, which is labor market. And some of the other broad indicators on the left-hand side are still quite benign, which is why I'm here not to tell you that US can't go into a recession. We just feel at JP Morgan Asset Management that the probability of US going into a recession till such time the unemployment is so low is quite low. So never say never. So we're not saying that the US is not going to go into a recession. It's a large economy. It does go through recessions and expansions. But just looking at a broad spectrum of data, there are a couple of flags. So say out of 6 indicators, there are 2. You know, this is not a perfect way of saying it, but you could say, let's say, 1/3 probability that the US may go into a recession, 2/3 that it may avoid a recession. Let's address the eye in the room, which Rajul alluded to, which is inflation. And I'm showing you the inflation number in US. And what I'm doing here is breaking it up in the form of different constituents of that inflation. So if you notice that the inflation print that came out in July, which is 8.5%, thankfully is better than 9.1. It's still high, but at least the direction was upwards till the previous month, and it's beginning to moderate now. But if you cast your eyes towards the left-hand side of this slide, you notice in March of 21, a little over a year back, inflation, which was at 2.6%, the different components were a lot smaller. Of course, what's happened is oil prices have shot up significantly. US is reopened, and therefore people are beginning to travel. And as a result, there is more demand, less supply of multiple goods and services. So you notice that some of the biggest contributor to this high inflation is energy, which, as we know, after staying at $120 to a barrel, is now moderated close to about $90 odd. And therefore, you see the moderation in the inflation in the US. Rajul also alluded to supply chain issue and supply constraints or shortages of semiconductors, which, by the way, are used in a significant manner in new cars nowadays. And because there weren't enough semiconductors available, there weren't enough new cars rolling off of factory floors in the US. Consumers are strong. They wanted vehicles. Instead of getting it new, they started going to used cars, and therefore used car prices started going up. The good news there is, because of moderation in demand now, and because companies and car makers have now set some supply chains in place, diversified their supply chain, they are beginning to have more cars roll off of factory floors, and therefore that red part of inflation is beginning to moderate significantly. The parts that's looking sticky, Rajul, is the one that I experienced personally. I spent most of July in California driving up and down that state. I must have driven about 3,500 kilometers. I can tell you, even a decent, not a luxurious hotel was going at $500, $600 a night, and they were sold out.
That's revenge travel for you.
Absolutely. And, when I spoke to some American travelers there, they were like, listen, we've been cooped up for the last couple of years. This is our first summer break. We know we're paying through our nose, but hey, we haven't paid for the last 2 years, and this we're probably not going to spend for the next 6-8 months as well. So we had a similar sentiment when we traveled from here, because unlike you, Rajul, who could travel within India, guess where I in Singapore could travel? An exact from one end to the other of the island, 45 kilometers, and that's the longest end of the island. So that was a revenge travel for us as well.
Situation, yeah.
So the restaurant, hotels, transportation is a little bit more sticky. Shelter, which is home prices, rentals, that's sticky, as it's in India as well. But the top half of this inflation is what is known as transitory. As oil prices moderate, if they do, it's likely to temper down inflation. New used car vehicles are already coming off, so that part is likely to moderate. What's not going to go away in a hurry is the shelter and the fact that the Americans are traveling all over again within the country, and therefore adding to inflation. I'm just going to add that we believe, because of this moderation, inflation will moderate to close to about 5.5–6% by the end of the year. It's not going to come anywhere close to the central bank's target of 2%.
2%.
But still, compared to 9% that we saw earlier, Raju, 5.5–6% is a lot better number. Now,
in the medium term, what do you think it will hover around? When do you think it will go back to 2? I know it's dependent on a lot of other things.
Yeah, so it really depends if the interest rates, which is the next part that I wanted to speak about, That continues to harden. Now, clearly one tool that the central bank always has to battle inflation is to increase the cost of money, which is by increasing interest rates. And what I'm showing you right over here is essentially the current rate rises in the US. And you can see that in the mid 2000s, towards the left of the slide, there was a similar trend where interest rates were going up. But the pace right now is a lot faster. So 75 basis points in the last two. The market is split that the next policy they might raise by another 75 basis. We think it's going to be 50. But the reality is that if you notice that blue dotted line, that's the central bank's own projections. They think they're going to peak out at 3.8%. That currently is 2.25% to 2.5%. So you've got another 1.5% to go before the, according to the central bank, they're done with raising interest rates. That, Rajal, is also having an impact on consumer sentiment, which is what I showed you in the first slide. Now, as consumer sentiments take a hit, they consume less. That means there's less demand. There's also better supply because supply chain issues are being resolved as we speak. They can't remain forever.
Right.
The supply-demand imbalance, which has been feeding into inflation, is likely to moderate. Again, I qualify that. What's not going to go away is wage inflation because unemployment is historically low in the US. I don't know if you're aware of this data, but currently, for every unemployed worker in the US, there are almost 2 jobs available.
2 jobs, yeah, 1.8.
That means that the wages are going to go up, and the Federal Reserve has a challenge to cooling off this wage inflation, which basically means increasing the unemployment in the economy, but avoiding a recession at the same time, which is why the markets have been so volatile. From the start of the year, the markets have been pricing in a significant probability that the Federal Reserve may not be able to walk this tightrope and avoid a recession. And therefore, the markets at one time in the US were down 25%. They've recovered since, but that was one of the reasons why the markets fell sharply.
So just to interrupt, do you think the US government could resolve this, the demand and supply issue as far as job openings are concerned, by outsourcing, maybe getting more liberal, maybe with their visas? Do you think that could be a solution there?
With the midterm elections coming up in the US, very unlikely.
Not right away.
Political hot potato, what you're going to see are more populist items, like you saw last week. President Biden's agreed to call off $10,000 of student loans. There's going to be inflation reduction bill that's come out. These big symbolic announcements.
Right.
I don't think you will see a political hot potato like immigration being brought up anytime soon. I could be wrong. I'm not a political expert, but the probability of that, in our view, is quite low right now. So, which is why more supply of manpower is not necessarily a solution that we are assigning a lot of significance to.
Okay.
But so I've spoken about some of the challenges, but US economy actually is very similar in terms of the construct of its GDP to Indian economy, but it's different in a way. So just like in India, that almost 2/3 of our economy is contributed by consumption, in the US, almost 70% of the GDP is constituted by consumption. The difference between India and US is in India, 80% of that consumption is staple consumption, which is your basic daily needs. In the US, 80% of that consumption is discretionary consumption, which is like cars, Apple products, and electronics, and so on. So that's the difference. But again, in order to gauge the health of the US consumer, this slide is very, very useful. Quick reference on the left-hand side, you see the balance sheet of the US households. Lots of assets, $170 trillion of assets almost. Fewer liabilities. And that's largely because of the lessons that consumers have learned from the global financial crisis, where they were levered. On the top right-hand side, we're showing you those lessons. So you notice in the middle of that top right-hand side, you see 13.2%. That was the percentage of disposable income that American households were spending in furnishing their loans, so EMIs. That percentage, which is going in the form of EMIs, is now 9.5%. Cast your eyes through the time series. It's never been that low. It's risen from the previous times because interest rates have gone up and therefore the EMIs have gone up.
Right.
And the final point I'll make is we all know that over the last 2 years, since the start of the pandemic, the government and the authorities in the US very literally put free money in the bank accounts of Americans. That totaled up to an excess saving of $2.26 trillion, which I'm showing you on the bottom right-hand side.
Mm-hmm.
The excess savings, which was stimulus money, pandemic bailout, and the fact that they haven't spent, amounted to about $2.2 trillion of excess saving. That's a lot of money. Now, because the stimulus has stopped, a lot of Americans haven't started working again. They're still relying on those checks, which were there from before. They're beginning to draw down on that, which is why the drawdown you see on the bottom right-hand side is about $0.33 trillion. But it still means that there's close to $1.9 trillion of additional savings that American consumers have. Again, not to say that it means that the US can avoid a recession. It's one of the reasons we think that the probability of a recession in the US is low. That being said, if the US economy does go into a recession, Raju, it's not important that the recession is going to be as violent and deep as the previous two recessions.
So please, if you could just pause for a second, I wanted to ask you on your previous slide, just to once put it into context, how much is $2 trillion? So India's GDP is just about $3 trillion. So 2/3 of that is the amount of household savings which people there are sitting at. But Supreet, would you know that how is this broken up? I mean, what part of this is with the middle income group or the lower middle income group, and what part of this would be with the higher income group? So because that would give us some sense of whether this money would go into discretionary consumption or staples.
So it's clearly in the middle and lower, Raju, because that's the base.
That's where it was given.
Exactly. I mean, those handouts, those checks had a criteria of income. So clearly it was given to people who belong to the middle and the lower income category itself. Clearly the most privileged did not get a bailout, at least in the form of checks. Quantitative easing, many people argue, was their form of bailout, but that's not something which directly went into their pockets.
Okay.
So coming back to the point and the discussion on recession, Rajul, the memory of the previous two recessions in our minds is quite jarring. So it was the global financial crisis, which was pretty rough, which is shown in that bubble, which is second from the right. I want you to focus on the right-hand side of the slide. And the pandemic was particularly rough. The economy was shut overnight. So that gave up 10% of its GDP at that time. But what I want you to focus on are the smaller bubbles, which essentially says that smaller, shallower, and short-lived recessions have happened in the US. So even if we go into a recession this time, which is the 1/3 probability that we are assigning, we believe it's likely to be a shallow and a shorter-lived recession than some of the ones that we've experienced over the past couple of recessions. So hopefully that gives you a sense of the largest economy in the world. There are some red flags, but we're not convinced that it's going to a recession. The consumer is strong. They have a lot of excess savings and they're healthy because the balance sheets are healthy. And even if they were to slip into a recession, it's unlikely to be as significant as the previous two.
So Supreet, for recession, it is just that 2 consecutive quarters of negative growth means recession that we have already seen. So it's more a technical recession. But I mean, what would be your definition of recession in that sense?
So clearly, so you're right. Technical definition is 2 consecutive quarters, but there is a technicality there as well, because the way they calculate GDP, it includes inventory. It's complicated, but it's a mathematical technicality. What you need to see is unemployment rise. If unemployment rises, the consumer confidence, which I'm speaking about, which is their ability to consume, that drops significantly, because if people don't have jobs, they're not going to do that discretionary expenditure. Rajul, if I'm not comfortable about the prospects of my job, I'm not going to go buy a car.
Yes.
So that is when spending, which is, by the way, 70% of the US GDP, that is when that starts taking a toll. So you really need to see that unemployment number go up from the current really low, historically low levels for you to start assigning a higher probability for a recession in the US.
I think Fed chairman alluded to that yesterday when he said that he wants to see labor market, the tightness going away in the labor market. that is when, they would feel comfortable that inflation will not be sticky from then on, maybe.
Yeah.
So
the tightrope they have to walk, Raju. They're
yeah.
almost walking on eggshells here.
Yeah. No, they wanted to set the expectations right, where I guess a lot of market participants were expecting that Fed would start easing out or cutting rates from the middle of next year onwards, or maybe even March onwards, March 23 onwards. So I think half the game in managing interest rates for inflation is managing expectations. And if nobody believes you're going to be tough, then it will be long drawn out. It can't come under control. So I guess that's what they're trying to do. So Supreet, thanks for those excellent insights on recession. It was very refreshing because we had not looked at it this way and in so much detail. So if we talk about, the extreme volatility now, which we've witnessed in the developed world markets last couple of years, I have not seen this kind of, market movement of 3-4% on a daily basis. I mean, I've been in the markets for nearly 30 years now. So is this a one-off since we've had 2 back-to-back events, or is this a new normal and should this bother us?
I think it's a great question. And it brings me to an analogy which I use very often. I apologize in advance, it's slightly morbid. There are 3 certainties in life, Rajul. Help me out with it.
Sure.
Death. Sorry, that's a morbid topic.
Yes, it is.
Taxes. Well, unless you're joining in from Dubai. And third is volatility. And it's interesting you mentioned that in your career, which is a very rich, long experience, Rajul, you haven't experienced this. Actually, you have. It's just human memory does not serve you as much, because when you're living through it, it feels terrible. But a couple of years out, you tend to focus on that time. So on this slide, what I'm showing you is the performance of the US markets over the past 42 years. So the gray bars are showing you the calendar year returns from S&P 500, which is the bellwether index in the US. Right. The red dots is the volatility. The red dots is the biggest decline or the steepest decline intra-year in that year. So for instance, the way to look at this is right now, this year, which is 2022, the markets at its lowest point gave up 24% of its value. That's 1/4 of its market capitalization. It's the largest capital market in the world. But if you cast your mind, Rajul, 2 years back, 2020, and remember how the markets were doing at that time. And by the way, notice where US markets had fallen. It had given up 1/3, more than 1/3 of its value, down 34%. Actually, if you think you're feeling bad about the economy or the economic order right now, I felt a lot more miserable at that point in time, because I didn't know that in this bizarre upside down world where people are locked down, businesses are not supposed to go back online, how our economy is going to survive, how are banks going to stay solvent, how are individuals going to continue to stay employed. So I felt a lot more miserable at that time.
Right.
On hindsight, Rajul, I wish I'd put more investments at play in my personal account at that time. I did put some money, but I promise you, there was not a single financial data that supported an investment thesis in the market at that time. Because if you opened Economic Times in India or Business Standard in my part of the world, if it was Bloomberg or Financial Times, it was just bad news. Yeah. If I wanted to look for any single data that would have encouraged me to invest in the market, there was zero. But again, on hindsight, when we were feeling absolutely miserable about the economy, about the markets, was probably the best time. I mean, think about India. India went through a very, very tough time in 2020 and till end of 2020. Again, there was no economic data because it was a draconian lockdown overnight. Economy shrunk. And again, there was no financial data that supported an investment thesis, other than the fact that the markets had become a lot cheaper because of this big fear in the market. So remember what I said, volatility is one of the certainties of life. It's almost like the price you have to pay for you to participate in the markets. You can't have a straight line return. And therefore, every single year, if you look at this slide, the red dot will be from anywhere from high single digits to 20-25%. So it's one of the certainties that you have to live with. But the good news here is, again, if you were to stick with my thesis, which is when everybody is fearful, there is an opportunity for a long-term investor. What I'm showing you here are similar events, geopolitics or financial events that have happened in the past. So whether it's the Gulf War in the 90s, the US invasion of Afghanistan or Iraq, 9/11 attacks, the global financial crisis, COVID-19 lockdown, these are pretty significant geopolitical or financial events. And the markets did show a lot of volatility. But I want you to focus just on the blue bars. Most of the times, an investor who stayed the course and stayed invested actually earned gratification in their portfolios. I did a simple average of these events. It comes to about 35% on average. But again, I'm an asset management professional. I always have to qualify. Past returns is not an indication of the future. But there is this history behind volatility and how it presents an opportunity for long-term investors. Rajul, I'll pass it back to you.
No, sure. I mean, one needs the courage to be, brave and keep investing, even when markets are very, very low, everything looks very bleak. And those are the investments which are rewarded with the highest returns. So obviously, no one will put all their money at those bottoms, and nobody can. But even if we put something, that part of the portfolio will, of course, look very rosy. Maybe like you are saying, just a year or two from that big event. So, okay, so Supreet, what about technology stocks? They have taken it on the chin. They were the market's favorites just before this correction. And now they have actually seen the sharpest correction in some of the biggest names. So what is the future of these companies and their stock prices from as a fundamental perspective? And do you see a prolonged time correction continuing in these stocks? And how are they now placed on valuation parameters? And so we have investors in some tech funds. What should they do?
So let me start by saying that over the long term, the biggest driver of stock prices is its profit growth. As in the asset management industry, we like to complicate things. We call it the earnings growth. Right. So as long as earnings are strong, over the long term, they will be the primary drivers of stock prices. In the near term, there are reactions from the markets to news. So when Russia invades Ukraine, when Federal Reserve starts raising interest rates, when energy prices go up, that starts having an impact on investor sentiment in the near term, and therefore causes the broader complex of technology stocks to drop as well. It does not alter the long-term prospects or the long-term ability of these companies to generate profits. And for your benefit, I've put on screen some of the mega trends which are not interrupted by geopolitics. They're not interrupted because of interest rates and inflation going up. For instance, Rajul, I'd much rather do this in person, standing in front of you. I'm fed up of Zoom, but we know that even though—
Welcome to do that on your next visit to India.
I look forward to it. But the reality is, even though the world is going back to normal after COVID, we are going to keep using cloud computing. So, for instance, Zoom is a cloud-based software as a service. I know for a fact that all of us on the call, if we do work, probably during the pandemic, moved our businesses online on cloud. Your client data, your software, your accounting software, everything went on cloud. And that's not going to go away. People are not going to say, okay, let's go back to the servers in the office. It's irreversible. So this digital transformation of the world, which is anyway underway, it's got accelerated in the COVID time. The artificial intelligence, machine learning is not just about these cool party tricks on an iPhone where you say, show me pictures of all dogs and all dog pictures are going to come up from your photographs. But it really has application in business and even in medicine. Rajul, machine learning actually is one of the tools being used for early diagnosis of critical illnesses like cancer, for instance. Tremendous application there. And it's only going to improve as technology improves, as semiconductors improve itself. Autonomous and electric vehicles, I can claim today that in our lifetimes, majority of the vehicles on roads are likely to be electric vehicles, if not autonomous vehicles. It's going to take a few years, but the change is clearly taking place.
Absolutely.
In India, I think India's one of the pioneers in electronic payments with UPI, tremendous application globally. In the US, 70% of the payments are still cash, by the way. I experienced it. Not something that I experienced in Southeast Asia or in India. So tremendous opportunity there. And it'll be interesting to see what blockchain technology has to offer for this adoption of electronic payments. It's been a while since I've looked at cable TV, over-the-top streaming, which is,
Same, yeah.
we call it Netflix, Hotstar, Disney Plus, whatever you want to have it.
Yeah.
We're just not consuming the regular television as much anymore, and newer things are going to come over a period of time. Absolutely. I also mentioned that I drove 3,500 kilometers in the US and California, Rajul. I did not see any hoardings other than lawyers. It's a very sue-happy country. All I saw was just lawyers advertising. I did not see Apple. I did not see most of the stuff that you and I would be interested in on hoardings, because they're moving to digital. Yeah. That is where the consumer is spending time, whether it's on their phone or laptops or work. And that's where the transformation of advertising is taking place. These are irreversible trends which do not get affected. Of course, what price you assign to those companies is in the near term dependent on certain factors. So for instance, software as a service, which is companies operating like Zoom, which essentially have a software which we use as a service. Salesforce, if you use a CRM software, Salesforce is one of the leading players there. ServiceNow, JP Morgan is one of the clients. So all our issues around technology, if you want to raise a button ticket and all, ServiceNow does that. All of these companies were trading at a significant premium to the market in the previous couple of years. Of course, the recent risk-off and the rise in interest rates has dropped them down. So you notice on the left-hand side, there's been a 62% pullback in valuations. The valuations as of June were similar to the valuations that we saw these companies before the pandemic, actually around December 2018. So it's given up all its gains of the pandemic and then some, and now trading at valuations of 2018. So, for a long-term investor, again, this presents an opportunity. I apologize for that gray part of the slide. We're masking the name of the fund because we didn't want this to be a product push. Yeah. But this is a JP Morgan strategy that's available in India. And it's specifically focused on technology in the US. And what I've done for you is I've given you that red rectangle, which is where I want you to pay some attention. So a standard measure of valuation, if it's expensive or cheap, is a price earnings ratio. That price earnings ratio at 22.7 is the cheapest I've seen in the past 5 or 6 years since I've been covering this fund. Right. That, by the way, Rajul, is not very far away from the P multiple or valuation of the Indian stock market, let's say a BSE Sensex or a Nifty, which is at 22.1 now. So you've got the leading technology companies in the world now trading at a valuation which is very similar to the Indian stock markets.
I think even their growth numbers and return on capital employed is very close to, some of the good Indian companies, which what we always quote. So this is kind of an eye-opener that in terms of valuations also, you are getting these companies at a similar valuation.
And that's a good point that you made, because the biggest pain in this correction, Rajul, is actually in what we call as YUCs. It's an acronym for Young Unprofitable Companies.
Right.
Let's face it, I think the world was high on a Kool-Aid over the last couple of years, because as long as you had a subscriber base and you're growing your subscriber base, even if you're burning cash, there is no profitability in sight.
Right.
You could assign whatever valuations to that business. Those companies are hurting. So an average stock in NASDAQ 100 is down more than 50%. It doesn't mean that the leading companies are hurting. Clearly, leading companies' stock prices are down, but they're still making profits. And as I mentioned earlier, Rajul, that the biggest driver of stock prices over the long term is profitability. And as markets start focusing on that variable, many of them are going to prevail as well. But it's a good observation you made about the return on equity, which is a great measure of the quality of businesses that you own, because a higher return on equity means these are profitable companies and likely to continue to grow their earnings in the future. I gave you an example of autonomous vehicles just a moment back. Before we segue to the different topic, let me just try and use a trivia, Rajul, with your permission for the audience. Speaking of autonomous vehicles, let me ask you, and please don't Google this because that takes the fun out of the trivia. Which company has the world record for the longest autonomous drive in the world? Once again, which company has the world record for the longest self-driving record in the world? I'll reveal the answer when I get to it.
I would think it would be Tesla, no?
I'm going to reveal the answer in a moment. Let's just allow the others to think about it as well.
Okay.
You just need to think about the answer in your mind. You don't need to post it anywhere. We'll come to that.
Okay.
In the meantime, I'll pass it back to you.
So, okay, so Preet, so I mean, that was indeed very interesting because, you know, this ROC number of 17% for these tech companies needs to be seen in the context of the interest rates at which, you know, risk-free capital is available in a country like US versus India. So there is a lot of difference, and we are probably looking at a similar return number there. So, I mean, that was just putting it into context. So coming to now China, which is the second most important economy in the world, but one which is completely opposite in some sense to what US offers or stands for. So if US stands for predictability, reliability, transparency, China stands for uncertainty and opaqueness. And for investors, whether they are FIs or individuals, it is an enigma, which we think we understand, but probably we don't. And hence we are kind of a little hesitant to participate in the markets, and more so, you know, in the last 1 year. So should we and can we afford to ignore the Chinese markets? What do you think?
Short answer is no, but let me qualify that with justification. Many of you on the call are aware that in the next decade, China will surpass the US as the largest economy in the world. But that's not what is interesting to me. What's interesting is on the right-hand side. What I'm showing you here is that just as comparison to some of the other developed economies like US, like South Korea, when they reach on the x-axis, which is the horizontal axis, is urbanization ratio as people move to cities. On the y-axis, GDP per capita, which is a measure of wealth of a nation. As you move from left to right, which means that as urbanization increases, the country keeps getting richer. And when they hit an inflection of about 65% urbanization, the wealth of the country increases significantly. Mm-hmm. China is now currently at about 60% urbanization. Their GDP per capita is about 10,200. For context, 20 years back or 22 years back in 2000, their GDP per capita was about $950. They've grown their GDP per capita 10 times over the last 20 years. They've moved from a low-income country to a middle-income country. Their aspirations now, Rajal, is to become a high-income nation like US, like South Korea, where GDP per capita is upwards of $30,000. What got them from a low-income status to a middle-income status is not what's going to take them to a high-income status, which is why this slide is important. I apologize again, there's a lot of text. I don't want you to worry about it. What I want you to focus on is just big terms on the left-hand side. It speaks about 7% GDP, boost international investment, quantitative target, 7.5%. So the message in the early 2000s in China in their 5-year plans was grow fast. We don't care about the quality of growth, just quantity of growth, which gave rise to this period of boom and bust in China, which was strong growth followed by some periods of extreme negative environment. But notice the previous two, or the most recent 2 5-year plans. You start seeing terms like innovation, environment, domestic demand, self-sufficiency in technology, common prosperity, which sounds a lot like Prime Minister Modi's Sabka Saath, Sabka Vikas, environmental protection, and so on. So the language has changed to capture that in the 2000s, it used to be external demand, investment, manufacturing, and manufacturing of textiles. That's how we in India used to know, oh, if there is a trainer or a shoe that's coming, that's probably made in China. But 2021, China is known for internal demand, or their policies are focusing on internal demand, so consumption. Services instead of manufacturing. Today, services contributes more to their GDP than manufacturing does, which is just like India and US. And they no longer manufacture textiles. That's gone to Bangladesh, Vietnam, and other places. They manufacture cutting edge technology now. So the China that we've been familiar with over the past 2 decades is very different from the China that we know today. The question that I asked just a moment back, which is which company owns the world record? I think somebody did respond in the Q&A box, trying to pull it up, but well, that company is, that's a question. Sorry, apologies for that. So the company that owns the world record of the longest self-drive is a Chinese company called Xiaopeng, or XPeng for short.
Wow, that's a surprise.
In March of 2021, Rajul, XPeng's P7 cars drove a distance of 3,600 kilometers, very similar to the distance that I drove in the US, from Hangzhou to Beijing, with an average human intervention of 0.7 for every 100 kilometers. So less than 1 human intervention for every 100 kilometers. So Tesla doesn't own that world record. It's actually a Chinese company. So the reason I bring that up is, again, it's a different China. So on the left-hand side of this slide, you see the number of patent applications, highlighting how technology is embedded in China's economy now. They're leading even the United States now. On the right-hand side, we're showing you the amount of GDP being spent in research and development. 20 years back, in both these cases, look at where China was. China was non-existent in the late 90s in technology. Their R&D spends in the late 90s was almost negligible. They're now a $16 trillion, $17 trillion economy, and they're spending 2.5% of their GDP as R&D spend. The reason I'm showing you this, Rajul, is on the left-hand side, the patent applications today are innovation of the future. And on the right-hand side, the R&D spends of today are the profits of the future. So again, I want to emphasize that while it's opaque, it's something which is characteristic of an emerging market. Several emerging markets have this. US is a wrong comparison. They're a democracy, they're a developed market and so on. But within emerging markets, that's one of the things that you have to contend with, which is why I keep going back to that range of outcomes. While I'm giving you this strong case on China, not for a second am I implying that put bulk of your money into China. That's not the point here. But the point I'm trying to emphasize is it's too significant an economy not to be represented in your portfolio. One other point that I do want to make, Rajul, is, sorry, I'm just moving around, is around climate change. This is a topic which will dominate headlines once inflation stops dominating headlines. Is around how do you make sure that the planet does not go down a toilet sinkhole. And if you notice on the left, or
does not evaporate the way things are currently.
Exactly. So on the left-hand side, we're showing you the biggest emitters of greenhouse gas emissions. China emits twice as much of greenhouse gases as US or Europe. It's not their fault. US outsourced their manufacturing over the last 20 years to China, which is why, since they have the most factories, they're consuming a lot of coal and so on. But even China's committed to going carbon neutral, which means they're going to extract the amount of carbon that they emit in the air through technology, either by transitioning to greener energy or sequestering carbon out of it. They've committed to 2060, which is granted 40 years away, but look at the magnitude of the task ahead of them. US and Europe are already on their way. So they've committed to 2050.
Right.
Their task isn't as onerous as China is. On the right-hand side, I'm showing you that China today consumes 85% of its energy comes from fossil fuels. And over the next several years, it's likely to be majority of their energy needs are going to be through renewables. And I think it's worth mentioning that today, China is a global leader in solar power. They own 70 to 90% market share in supply chain of solar. So whether it's solar panels, polysilicon, solar wafers, basically the raw materials that go into a solar farm, China owns 70 to 90% market share. If you follow the news recently, the authorities have announced a $1 trillion infrastructure plan, where bulk of the allocation is going to go towards, or the biggest beneficiary is going to be renewable energy in China. Just in the recent months, they've actually started building solar and wind farms in the northern deserts of China, which by 2030 will start producing renewable energy, which amounts to the total renewable energy that Europe today currently produces. Right. Just final statistic on this topic, Rajul, which is by 2025, which is just 3 or 4 years away, China is expected to generate 1,400 gigawatts of renewable energy, which is actually slightly more than US and Europe put together.
Wow. I mean, that itself should result in lowering of oil prices, I would think.
You would hope so, because
medium to long term
as well. But it also throws up a lot of opportunities for stock pickers like ourselves who manage portfolios in China and the Greater China region. So, that's something which we're looking forward to. So it's not the China that used to make textiles and low quality, low tech products. It's a China which is richer, on its way to becoming a rich nation, which is throwing up opportunities in consumption, throwing up opportunities in technology and cutting edge technology as well. So, and of course, as they transition from fossil fuels towards renewables.
So you don't see any structural risk from the recent meltdown in the real estate sector, because that indeed was 1/3 of their GDP. In the near term, I'm talking about. I mean, medium to long term, of course, this all looks very good.
So one of the goals which I mentioned of the Communist Party or Chinese Communist Party, Rajal, is common prosperity.
Yes.
They don't want to leave people behind, even if it means slamming the brakes on some of the sectors. One of the barometers of common prosperity is people's ability to afford housing. Their motto is housing for living, not housing or property for speculation.
For investing or speculation, okay.
So it's not to say that they will be able to walk that tightrope of just letting, speculative businesses go out of business. There will be collateral damage, which is why when you're looking at investing into China, it's important to, first of all, be balanced in your approach and to look for an active manager that can avoid some of these minefields, because as you rightly noted, Rajal, it's an opaque market. You can't trade China sitting out of India. Let's face it.
Right. Yeah.
You need to be on the ground in China, in Shanghai, in Beijing, in Hong Kong, Shenzhen, for you to know the pulse of that market, that economy, for you to be able to do it. And at JP Morgan Asset Management, we do have those resources. So the reason that if I'm able to sound even remotely knowledgeable about this is because of my colleagues based on the ground in those locations, not because I've been to China too many times. Yeah, simple message. Property.
No, of course, I mean, we cannot make direct investments in China. We know nothing about their companies, or, I mean, we really do not have the full picture basically sitting here, which is true.
And just like in India, I would say one of the least liked sectors in a growth market like India is state-owned enterprises, public sector-owned enterprises. In China, some of the least attractive businesses for stock pickers like us, like portfolio managers, is some of these state-owned enterprises, because as is the case in India, Rajal, the state-owned enterprises serve the interest of one shareholder, which is the state. They don't serve the interests of all shareholders, and which is what we don't like. And therefore, we look for private businesses, and there are plenty of private businesses, some of them very large names that many are familiar with. Some of them are lesser known names on their way to becoming the future large names in China. But just like in India, where you find dynamic entrepreneurs, great businesses, you find that in China. Are there bad businesses? Of course, there are bad businesses. The idea is to stay away from them.
Understood. Yeah, so stock picking is key again in a vast market like China. Okay, so let's briefly also talk about Europe. So that is, to my mind, one region which will suffer most, whether it is inflation readings or the onset and duration of recession. Can you share your views on the same, just briefly?
Yeah, no. So while I said that the probability of US going into a recession is quite low, Rajal, unfortunately, that's not what I'm going to say for Europe. In fact, in our view, Europe, it's imminent that Europe's going to go into a recession. Sadly, it's going to be a very, very rough and cold winter for them. Energy prices, while they're moderating in the US, because US is the largest producer of energy, Europe actually depends a lot on Russia. I'm sure many of you must be familiar. They depend, before the recent sanctions, 25% of their oil came from Russia and 40% of their natural gas came from Russia.
Right. It's
a little bit like, I'm gonna break into Hindi, Rajal. So that sanctions that they've done is, you could argue it's hurting Russia, but it's hurting Europe. But they need to find alternatives. Alternatives are not cheap. supply chain issues. If you're gonna shut down gas pipelines, you need physical infrastructure like LNG carriers to ship that LNG to Europe. So whether it's cost of energy, consumer confidence, interest rates, which we think the market is underestimating in Europe because of inflation, interest rates are going to go a lot higher in Europe.
Right.
We think, sadly, the stars are aligned for a recession in Europe, unless this geopolitical tension resolves and you start seeing different dynamics on energy prices. But the biggest determinant right now is energy prices in Europe, and therefore we are less sanguine about the European economy.
So pretty great. We have covered, I think, international economy and markets from various angles in the time we had. But the question, we come up against the most, and in the last, especially in the last 1 year, is that why allocate it all to international funds, since India has been the best performing equity market this year? Most investors feel they should stick to what they understand. So what is your take on this?
Yeah, so just give me a quick second. Yeah, so this is, again, a colorful slide. Again, my apologies, but what we're trying to do is show you calendar year returns from a collection of markets. So 2012 till 2022, which is year till date. And the country on the top, the cell on the top is the best performing market, and the country on the bottom, or the market on the bottom, is the worst performing in that calendar year. And in the red rectangle on the right-hand side, I'm showing you in the second column from the right, the 10-year compounded returns from these countries. And the extreme right-hand column is how much risk have you taken in order for you to get that return. So if you're higher on the second column from the right, that's good. If you're high on the extreme right-hand column, which is risk, that's not good. You ideally want to be in the lower part of the extreme right-hand column because you want to take lower risk or reasonable risk. Now, just focusing on the second column from the right, understandably, US has delivered the best returns over the last 10 years, but even markets like Taiwan and even India have delivered strong returns. But this is where complementary aspects of different markets start playing. It's not competition. The role of diversification into international markets is not that it's a race of one market against the other. They all belong in the same team, and that team is your portfolio. Each one of them has a role to play. The role that US plays is, while it's demonstrating reasonably strong returns, look at the volatility column, which is the extreme right-hand side. It's adding some of the least volatility over the last 10 years. Therefore, it's a very efficient market when it comes to the amount of return it generates for the risk that you take. India, however, because it's an emerging market, we all know the prospects, we're very bullish over the long term, but characteristically, it is volatile. So let's walk through over the last 10 years. Best performing market in 2012, one of the worst performing in 2013, one of the best performing in 2014, one of the worst performing in 2016. It tends to be a roller coaster ride.
Right.
Which is why many of you on the call like to try and time the markets. I don't know if you're successful or not. I certainly am not, because if you get your timing wrong in the near term, over the next 1 year, you can see some drawdown in your portfolio. That's the characteristic of any emerging market. But if you have a portfolio which is nicely diversified across India, which is home bias, and majority of the allocation should be there because those are companies that you understand, you can track on a regular basis. Our associates in Capital League can advise you on it. But there are plenty of businesses which are complementary, which are just not present in India. For instance, I spoke about some renewable opportunities in China. I spoke about technology opportunities both in the US and in China. They just don't exist currently in India because India is a different sort of an economy, while US and China are different from it. So once again, I emphasize, it's not to say it's a race between one and the other. I'm not here to claim that one market's going to do better than the other market. But if you can have a combination of markets in your portfolio, it makes for a more resilient portfolio in that different range of outcome. And one of the outcomes can be, what if India does not perform over the next 1 year or 2 years? I'm not saying that it won't. I'm just playing out a hypothetical scenario. The other thing to look at is, again, from a complementary aspect, what price are you paying for these different markets? So the way to read this chart is that vertical line for every market is the range of valuations, PE multiple that market has operated in the past 15 years. The horizontal blue line for that market is the 15-year average. And the green diamond is showing you the latest valuation, which is as of 24th, earlier this week. One observation for you is that India is at 22.3, which on an absolute basis, no other market is at 22.3. And also relative to its historical average, which is 15-year average, is at a premium. It's not to say you shouldn't invest in India. Of course you should. This is not the only reason why you should decide to invest in a market. But what you do find is, and follow those green arrows that I've given, markets such as Southeast Asia, ASEAN, which is a collection of Singapore, Thailand, Malaysia, Indonesia, Philippines, it's trading close to its long-term average. China, we spoke about, is trading in line with its long-term average and is at about 11 times. Taiwan, which is one of the countries which is known for semiconductors and technology, is trading at the lower end of its 15-year range. So again, the complementary point here, Raju, is you're at different points in time. Since the markets are going to behave differently, they're going to be different opportunities. And therefore, the role that different markets play is adding resiliency into client portfolios and not about this market's going to do better than the other market.
Right. So, I mean, some kind of diversification will basically ensure that the investment journey is smoother than it otherwise would be when you're pegged to a particular market only. Right. So, Supreet, let's look at a couple of audience questions. There is one on where do we see the dollar, and do you see an alternate currency system challenging the supremacy of US dollar?
It's a very popular question because dollar tends to surprise everybody, and it certainly will surprise this year as well. So this is a slide I kept in appendix because, as I mentioned, it's one of the popular questions.
Right.
It's been a phenomenal year for the dollar. So, by the way, just on the topics of holidays, if you're thinking about a holiday, international holiday, this could be a parameter. So Turkey is 30% cheaper relative to the dollar, but Indian rupees depreciated about 7%. So Indian rupee has actually done a lot better than some of the other countries. So look at Japan, look at UK, down 12% relative to the dollar. And on hindsight, it doesn't surprise us because you're going through a couple of periods. So one is you're facing higher interest rates in the US, which, by the way, for the longest time, were earning nothing. They're the most aggressive developed market central bank. Even ECB is hiked by 50 basis points and Federal Reserve hiked by 75 twice, and they expected to raise another 100 basis points through 50, 25, 25 for the rest of the year. Right. So clearly dollar investments are earning more. The other is quantitative tightening, which is a term for sucking liquidity out of the system. So if there are going to be lesser dollars available in the financial system, there is more, the demand supply dynamics support a stronger dollar. And of course, finally, there's the geopolitics. I think European currencies have also suffered because of the geopolitical issues and the fact that energy prices for them are going to be quite high as well. What is our guess? We think dollar, but dollar index is overpriced. I have to qualify that, not against rupee. So dollar index is an index that comprises 6 main currencies, which are pound sterling, euro, Swedish krona, etc. They're not. So if I'm saying that the dollar index is likely to depreciate, it's not a statement that that the dollar is going to depreciate against the rupee as well. It's quite possible that by this time next year, some of these developed market currencies like the euro, like the UK, pound sterling may have appreciated marginally versus the dollar. But for India versus the dollar, you need to look at inflation dynamics and interest rate dynamics.
Yeah, between the 2 countries, yeah.
India tends to have a high current account deficit, Raju, because we import a lot of our oil. We love gold, so we import a lot of gold, which is why our current account deficit tends to be higher. In the US, they are the largest producers of energy. They're energy self-sufficient. And by the way, the interest rate differential, which used to work for India earlier because Indian interest rates were much higher than the US, that gap is narrowing. The 10-year in India is what, 7% or thereabouts?
Yeah, 7.3.
Yeah, and the 10-year in the US is now 3%. So that gap is narrowed to 4%. It used to be 6% earlier. It used to be zero in the US and it used to be 6 in India.
Absolutely.
So While I will make a statement that dollar is expensive, but it's expensive relative to its developed market peers, you really have to watch the dynamics around oil. If oil cools off, rupee can appreciate because we import 70 to 80% of our oil needs, and therefore lower current account deficit. If inflation cools down in India as well, that's another reason for rupee to appreciate. But given the variables today, I would say over the long term, let's say over the next 3 to 5 years, rupee would tend to depreciate by an annualized rate of about 3 to 4%. If you look at the past 20 years, it's depreciated by about 3.5% annualized. It's never in the straight line. There are times it appreciates, the time it depreciates. But when you look over your shoulder 3 or 4 years down the line, very likely rupee would have depreciated in the order of about 3% relative to the dollar.
I think in the short term, it will continue to be a function of oil prices and FII flows, I would say.
True.
So, okay, so Preet, we'll just extend our session by another 5 minutes and look at a couple more audience questions. So there is one where they've quoted Fed chairman yesterday saying reducing inflation is likely to require a sustained period of below trend growth. I think that's what he said yesterday. So in this context, he's asking your view on value stocks versus growth stocks for the next 2 years.
I think it's a great question. And I would say just building into my thesis or the central message of prepare for a range of outcomes, that's the other outcome you should prepare for, which is it should not just be growth in your portfolio. Value would find you would find some sectors in value which tend to do well over a period of higher interest rates, like financials. For instance, if interest rates are going to go up, banks make better net interest margins. That happens in India as well. It's going to happen in the US. Financials is the biggest weight in the value index in the US. It does not form a part of the growth index.
Nice. Okay.
Similarly, industrials, energy, these are components of the markets which are not growth oriented and therefore will be absent in a growth strategy. And again, I want to emphasize, I'm not saying growth's not going to work. Growth is going to work over the long term, particularly as the market focuses back on earnings growth. But in the meantime, if the market is going to be dominated by news around inflation, interest rates, that outcome that I want you to be prepared for is a possible outperformance by value in that time. So don't abandon your growth. But if you're looking for an incremental allocation and want to balance your portfolio out, it doesn't it makes tremendous sense to have value in your portfolio as well.
Great. There is one question where they want to know what are the risks to this narrative, which is JP Morgan's view, which you would watch out for.
So number one risk, we're completely wrong on our inflation expectation. So I mentioned that in our view, inflation has peaked at 9.1%. It come to 8.5%. And if it goes to 5.5 to 6%, that thesis, if that's challenged, because let's say all of a sudden oil prices shoot up again and Americans start traveling even more, and that 8.5% becomes 9.5%, becomes 10%, we're completely wrong. So, that's one risk. Low probability of that, because as I mentioned, since demand is falling because of low consumer confidence, unlikely that that thesis is going to change, but of course, that's a risk. Geopolitics, we can never predict geopolitics, and we don't spend time trying to predict geopolitics. Nobody on this call could have predicted a year back that Ukraine-Russia is going to happen. So again, we don't waste our time, but we always say that geopolitics has near-term impact on market sentiments and therefore market valuations. So if that flares up, you're going to see the markets contract globally, not just in that isolated part of the world. I would also say the risk of the unknown. Raju, I mentioned a year back, the geopolitics was an unknown. So, this came out of the blue in early part of this year where the tension ratcheted up and very quickly led to a war in Europe. So risk of the unknown is,
Before that, I mean, COVID was an unknown. So yeah, that obviously.
Precisely, which is why, whether it's recession, interest rates, I do acknowledge that the macro factors have a number of items which can be a potential risk. Therefore, I keep emphasizing on a diversified portfolio. I made a statement in the beginning, not a time to be a cowboy and assign 100% probability to any outcome. At the same time, I don't think sitting in cash is efficient. By the time you get confidence by reading data in the papers, the markets would have priced it in many, many quarters before that. Markets tend to do that, Rajul, which is they look ahead in the future.
Markets are forward-looking, true.
I mean, I've seen markets when in a recession, when economic data is deteriorating, markets start rallying because they start looking at the Federal Reserve cutting rates and the economic environment actually improving 6 months down the line. So if somebody is waiting to read, okay, US or the world is a lot better place now, well, if you would have waited for that in any of the corrections in the past many decades, you would have missed out a lot of upside. So,
okay, Supreet, let's look at one last question. What is the prediction of the US economy post-24 in case Republicans come to power, which has the potential for deglobalization?
So for the US economy generally, and I'm generalizing this, it depends on their specific incumbent who comes in. But generally, Republicans are viewed to be more pro-business, almost like the incumbent government in India. Democrats are viewed to be more welfare-oriented, which is doling out more money, taxing the rich, taxing businesses. So if you do see the Republicans coming in, it generally becomes almost like, oh, BJP is likely to win again, and therefore the markets trading at, or at least celebrating that. So simple answer to your question, if you're looking for a specific answer, it's actually viewed more positively. Was there a second part to the question, Rajul, that I'm missing?
No, that's it. So, Supreet, I think this has been a very, very enlightening sessions we've had today. So would you want to summarize our discussion in terms of key takeaways from the investors' point of view?
Rajul, once again, it's been a pleasure and thank you for having me. And I do look forward to joining these discussions in the future as well. But while the news flow might change, which I'm confident it will, these are dynamic times. You started with it. We live in an interesting time. The topic of your discussion today was very interesting, disequilibrium. Markets are like a pendulum. They never stay at an equilibrium. They always swing on the other side. Volatility is normal, and hopefully I've been able to establish to you that volatility is the price that you have to pay in getting into the markets. Many a times for long-term investors, these provide an opportunity to build strong portfolios. Diversification is absolutely necessary. Please prepare for a range of outcomes, including a small chance or a minority chance of a recession in the US. But ultimately, staying invested matters, because I'm reminded of this quote from a revered investor, Rajul, John Templeton, which said, bull markets are born in extreme pessimism,
absolutely,
grow in skepticism, mature in optimism, and die in euphoria.
Yeah. I
don't know if it's extreme pessimism now or skepticism. I'm convinced it's not optimism or euphoria. So, with that, I certainly hope this session's been insightful for you all. I'll pass it back to you, Rajul.
No, great. I mean, in fact, a lot of these events are not in our hands. We cannot predict, like you said. So there is another saying which says, if you can't direct the wind, you can adjust the sails. So I think that is what we can do, that if we have the right asset allocation in the portfolio, which is very important, and that facilitates diversification and would help to reduce some downside when any of these markets correct. So that brings us to the end of our session today. So Supreet, thanks a lot again for your time and for an amazingly insightful session. And I'm sure everybody found it very refreshing, and it was topical. And I would like to thank everyone for your time on a Saturday morning. Thank you, Supreet.
Thank you. Have a great weekend, everybody.
Thank you, yeah. So may I request everyone to take 30 seconds to fill out the feedback form as you exit the webinar, and have a great weekend. Bye-bye.